Welcome back, traders. I'm glad to have you here today. The next long-term pattern on our list is the double tops and double bottom. Double tops and double bottom chart patterns are majorly for trend reversal. As we can see, double top and bottom patterns are chart patterns that occur when the underlying investment price chart moves in a similar pattern to the letter M, double tops, or W, double bottoms. A double top has an M shape and is a signal of a bearish reversal in trend, while a double bottom has a W shape and is a signal for a bullish price movement. A double top is a reversal pattern that is formed after there is an extended price movement upward. The tops are peaks that are formed when the price hits a certain level that can't be broken, which we can tag as a resistance zone. After hitting this price level, the price will bounce off it slightly, but then return back to test the level again. If the price bounces off of that level again, then you have a double top. As we can see on this price chart, the two peaks, or tops, were formed after the rejection of a strong bullish move up. Notice how the second top was not able to break the high of the first top. This is a strong sign that a reversal is about to occur because it is telling us that the buying pressure is trading at a potential resistance zone. Take note, the double tops chart pattern is not confirmed if the price does not break below the neckline. What's the neckline of the double tops chart pattern? The neckline acts at the midpoint here. This neckline is the support level for the bearish flow of price from the first top here, and the support zone at which the bulls made a second bullish move to test the first top level. A bearish price breakout below the neckline after the second top bearish flow would give the confirmation of the pattern. The double bottom is also a trend reversal formation, and it's the inverse form of the double top. This means the double bottom supports bullish anticipation whenever it appears at the bottom of an extended bearish trend. The bottoms are troughs that are formed when the price hits a certain level that can't be broken, which we can tag as a support zone. After hitting this price level, the price will bounce off it slightly and then return back to test the level again. If the price bounces off that level again, then you have a double bottom. As we can see on this price chart, the two troughs, or bottoms, were formed after the rejection of a strong bearish move down. Notice how the second bottom was not able to break the low of the first bottom. This is a strong sign that a reversal is going to occur because it is telling us that the selling pressure is trading at a potential support zone. Take note, the double bottoms chart pattern is not confirmed if the price does not break above the neckline. Where's the neckline of the double bottoms chart pattern? The neckline acts at the midpoint here. This neckline is the resistance level for the bullish flow of price from the first bottom here, and the resistance zone at which the bears made a second bearish move to test the first bottom level. A bullish price breakout above the neckline after the second bottom bullish flow would give the confirmation of the pattern. The double tops and the double bottoms can exist in different variations. Not all double tops or double bottoms will have equal tops or bottoms price level swings. Double tops can exist in three variations. Number 1, as equal tops formation. These double tops have almost the same tops price level highs. Number 2, as right higher top. These double tops have their second top higher than the first top. Number 3. As a right lower top. These double tops have their second top lower than the first top. Double bottoms can also exist in 3 variations. Number 1. As an equal bottoms formation. These double bottoms have almost the same bottoms price level lows. Number 2. As right higher bottom. These double bottoms have their second bottom higher than the first bottom. Number 3. As a right lower bottom. These double bottoms have their second bottom lower than the first bottom. As a beginner trader, master how to trade the equal double tops and double bottoms chart patterns before proceeding to the rising and falling tops and bottoms. How can we trade the double tops? To trade the double tops, the first step is to ensure a bearish close of price below the neckline of the chart pattern. Once this occurs, we need to study the volume breakout of the neckline and the bearish momentum that leads to the bearish flow to the neckline structure. There should be a strong bearish close of price below the neckline. Alternatively, there should be a strong bearish sell-off from the second top to the neckline. Once any of these two factors occur, it may deter the retest of the broken neckline. Traders can go short at the close of the bearish candlestick below the neckline. If there's no strong bearish momentum to the neckline or a strong bearish candlestick breakout of the neckline, traders can then exercise some patience to wait for a retest of the neckline to prove as a resistance for price. Traders can place their stop loss above the high of the bearish candlestick that breakout of the neckline, or simply place their stop loss above the high of the retest bearish signal candlestick. To determine the profit measurement objective, traders need to measure the distance from the second top to the neckline, and then replicate the measurement value downward from the neckline in order to forecast the profit target of the bearish pattern price movement. In the next video, I will show you how to trade the double bottom. You will also learn more about the rising and falling tops and bottoms variations.